One of the things that's been very rewarding to us is seeing the growth on the ESG, social, and Catholic side. Those areas have been our fastest growing parts of the market. They're still a minority of our assets, but over the last 4 or 5 years, they've been the fastest growing part of our business, and so it's something we're very excited about. It's great to see the interest in the broader market really picking up, as Sam and others kind of highlighted some of the U.S. SIF statistics and other things that show there. So I want to briefly go through our equity investment process, and the reason that's important is because when we started running Catholic portfolios in the year 2000, we had 2 design goals when we started this. We didn't start as a social shop or as a Catholic focused investment manager. We were kind of we were a generic investment manager, for a lack of a better description. But we had clients who were asking us to help them accomplish some goals, specifically with some faith-based approaches to investment portfolio management. So I'd like to briefly go through our equity investment process, because we had 2 design goals when we first made the decision to do a Catholic portfolio. The first is we did not want to make any compromises in our investment management process. So, do good and do better at the same time. We want to be able to give our clients the portfolios they want, but do it without sacrificing investment performance. So we didn't want to make any compromises on our investment process. And the second design goal is that we wanted to look at not just the negative side, which in the 2000 time frame was really the most common way folks approached SRI or any kind of values-based investing, was divestment. It was taking things out of the portfolio, exclusionary screening. We wanted to also bring in a positive element to it. So, and it was a group of nuns, frankly, who were talking to us. And they said, well, we'd love to avoid these companies, but we also, can you tell us which companies are really doing great things to protect child labor? Can you tell us which companies are doing great things to reduce sex trafficking? Environmental impacts, those types of things. And so we recognize, we can avoid the companies that maybe have some issues there, some known issues, and most companies, particularly in the US, have done a good job of kind of weeding that out of their supply chain. Nothing's perfect yet, but it's much better than it was 15, 20 years ago. But they wanted to be more proactive about looking for opportunities that were positive as well. So those were the 2 things we wanted. No compromises on the investment side, and then don't think about things just as purely exclusionary and negative, but look at positive elements that we can do as well. Couple just in terms of firm background, I'll just quickly go through this. We do try to incorporate a lot of the values that we look for in the companies that we include in our portfolios. And for 6 years running now, we've been, I think our corporate culture reflects in a way that has put us in pension and investment magazines, best places to work for asset managers with 50 or fewer employees. We've been picked as one of the top 5 spots in the last 2 years, actually, as the #1 spot there. And I think it reflects the corporate culture. For those of you in the advisor community, Advisor Magazine 3 times in the last 5 years has picked us as one of their asset managers of the year. And 4 years ago, that award was for the inaugural impact asset strategy, asset category. So we're very pleased with those recognitions. So on our investment process, it's a 4-stage process. You heard some of this. We're a relative value manager, look for quality companies. A lot of things that you heard from Westwood, quite frankly. I mean, there are a lot of things that we do that is shared with other managers. And so, as Matt was speaking, I certainly heard some things that resonated with and reflect some of what we do. So we kind of think of our process as broken down into 4 stages: structural risk controls, idea generation, fundamental analysis, and the sell discipline. I'd say one thing that sets us apart is, if you noticed on Westwood's slides, where a couple of these were shared, their structural kind of portfolio construction was at the bottom of the graph. For us, it comes at the beginning. We think about risk at the very beginning of the process. We think about portfolio construction at the beginning of the process. We're a bottom-up stock picking operation, but we think about portfolio construction before we think about the first stock. We want to control risk, minimize volatilities to the extent that we can, minimize that downside risk similar to what Westwood is trying to accomplish. And we think with good portfolio construction, things that we do up front, and then embedding that throughout our thinking in the security selection process, that helps us achieve that goal. So for us, risk control is very important, and it's embedded at the beginning of our process, and not kind of a reweighting of the portfolio after you've already picked the stocks that you're going to try to build into the portfolio. Second stage is idea generation. We have a set of quantitative models, proprietary quantitative models that help us identify the fundamental financial aspects of a company that we think are important. It's a value tilted, but we're also looking at expectational pieces as well. We've got a series of quantitative models that help us rank the entire domestic stock universe of stocks that we could look at, and that helps focus our attention. Feeding into then the third stage of the process, which is traditional fundamental analysis. It's just kind of a Graham and Dodd approach to financial statement analysis, looking for those quality items that really stand out and would reflect on, again, risk-reward, upside potential versus downside risk that we and others like Westwood are trying to capture. And then finally, the sell discipline just kind of closes the loop and starts the whole cycle over. So that's the process that all of our Catholic portfolios are built on. We use this in every equity strategy at Dana. And our Catholic strategy is no exception. What we do differently for our ESG strategies, Catholic being one of them though, is now we layer on top of that almost a parallel set of considerations that focus on the ESG and social values-based components of it. So we do use the US CCB guidelines. We started almost 4 years before those guidelines existed, but we do use those now as kind of guideposts for what we do. They are, as was pointed out from the audience and in other parts of the stage presentations, there is some subjectivity and interpretation necessary there. And there are differences of opinion. So, these are things that we work with our clients to try to understand and evaluate. We're looking at all of the ESG pieces, the environmental piece, the social piece, the governance pieces. We're looking at the exclusions as when they're necessary to comply with the US CCB guidelines. And then we also have a component that's the active ownership, and I'm going to go into that a little bit more. We start, as I said, the process on the ESG side kind of parallels what we do on our financial side. There's a quantitative front end. We get data from 8 different commercial ESG data vendors, but there are additional data sources through nonprofit entities focused on, for example, access to medicine or nutrition issues or supply chain issues. These are additional organizations that we work with in terms of getting data to help us score our universe of companies and limit our universe a little bit. And so we've got these scoring both on the financial side and the ESG side. Ultimately, though, it comes down to our analyst team picking stocks, and the ESG piece is just one part of that mosaic. Obviously, the financial pieces are very important, but the ESG pieces are given equal weight. I say equal weight, equal consideration, but there are many, many factors, and so if you think about the total impact it has, it may be a smaller piece. It's all part of a mosaic. We're trying to generate a picture of a company, and that's based on what we're going to make our decisions on. A couple of people earlier on mentioned measurement. We're trying to identify these things. How do we show impact of our portfolios? Our Catholic clients and our general ESG clients want to know, the process is great, but proof is in the pudding. What can you show me? What can you demonstrate to show that there's an impact? We've tried to do a couple different things. It's somewhat difficult because many of these things are soft. So looking at things like, how do we measure the impact of our supply chain work? We're working with some third parties to maybe come up with some quantitative metrics on that. But there are a couple things that we've been able to do. There are third parties that are doing ESG ratings, so we benchmark ourselves versus those third-party ratings. The chart we're showing you here show MSCI's ratings. We've used Sustainalytics as a benchmarking tool as well, and others. But you can see that all of our ESG strategies, including the Catholic strategy, score better than our benchmark, the S&P 500, in terms of those characteristics. We've also looked at one of the things that's been easiest to measure are some of the environmental impacts. There's more quantitative data in this front, so we've looked at water impact and other things, but the easiest one to because the broadest data is available is on carbon. And you can look at the carbon footprint of our strategies versus the S&P 500, and we're roughly 40% lower in terms of our carbon footprint, all in a sector-neutral portfolio, meaning we have full exposure to energy, full exposure to utilities, to transportation. But by careful stock selection with companies that are managing their ESG or their carbon impact, we're able to get substantially lower carbon footprints in our portfolios despite that. And so the last thing I just wanted to touch on is that we take the active ownership part. We're active portfolio managers. You're getting an active portfolio with the tracking error closer to 5% in our strategy. And we have generated over the long term excess returns that cover certainly the active management fee. But beyond active stock selection, we also want to be active owners. So you've heard a lot of people today talk about proxy voting. That's a big part of what we do. But we go beyond that. Martha started to certainly hinted at some of this, some of the things that we do on the active ownership side. We're very involved in shareholder resolutions. We have been lead filer in a few occasions. We co-file with through investor coalitions on quite a few others. We actively talk to management teams on ESG issues. In fact, it's been kind of Dana's process on the financial side not to talk to particularly the big companies. We talk to smaller companies, but big companies, Intel's not going to tell me anything that they haven't already issued in a press release. So we find it's much more efficient just to go to written resources to get that. But we have conversations with Intel and others on the ESG side, and it's great because it gives me insight into their management thinking, into the culture at the company that you can't get from reading a transcript or listening to a CFO give a canned presentation. So we've actually found it's helped us be better stock pickers as a result of those conversations. So we're very much active engaging in companies, with companies in topics of how they're managing their supply chain, how they're managing their environmental impacts. Again, using Intel as an example, you think water's not a risk for a company based in the US. Well, if you're a semiconductor manufacturer and you have a plant operating in Arizona, or California, if there's anybody from California in the audience, you certainly know what water resource scarcity can be. If water's a problem in a semiconductor fab plant and they have to shut down for a day, that's a major financial impact. So these are the types of things. It sounds like it's just something that a Birkenstock wearer is going to care about. But as a pure financial mercenary, I care because it has a financial impact. So these ESG things we think are very strong and powerful in helping us make stock selection decisions going beyond just the values component. And so a lot of what we're doing on the engagement and activism side we feel is beneficial not just to our social clients, but it actually spills over and affects those clients who are not involved in any kind of a social screening strategy that we run.